Hey, what's up, guys, and welcome back. Today, we're going to be talking about the Fed interest rate hike and what that means for the housing market and mortgage rates. You're going to want to stay tuned. I'll see you on the inside. Hey, good morning, good afternoon, or good evening, no matter what time it is. I hope that you, my friends, are having another amazing day. Quick one today. Fed raised interest rate. Oh, by the way, got to introduce my co-host, Josh Zuniga.
Damn, you already forgot about me? It became the Carl show real quick.
That's just
Check it out, man. Side piece. It's all good.
Humble.
Talk about it. Interest rates went up or going up. They announced.
Wait. The overnight federal rate.
Federal is different than the mortgage rate. Explain
Okay.
Explain that, because
So the Fed rate,
people get misunderstand that so much,
Oh, God. Okay.
and that's why they start panicking.
I'm going to try. I have a degree in this shit, so I know a little bit about what I'm talking about. It's very difficult to explain. I'm going to try to keep it easy. Okay, the 0.75 interest rate hike that you saw is something called the interbank loan rate. Essentially, what it is, the overnight rate that banks charge each other, or the Fed charges the banks in order to meet their minimum reserve requirement. All the banks are required to have a minimum reserve in all their accounts overnight to make sure that if there's a panic, something happens in the banking system, the next day people can actually get their cash out. Okay, that's what that is. What that does is that it increased the cost of capital to the banks. So the banks borrow money from the Fed or other banks at a very low interest rate. It's the best interest rate you can get. Okay, then they mark that interest rate up just slightly and give it to you as a consumer loan. Now, it could be a mortgage loan, it could be a car loan, it could be a personal loan, it could be an RV loan, bank, whatever it is, any kind of bank loan, credit card debt. And so then that gap there is what they actually make in profit. So if they borrow it from the Fed at 2% and then they loan it to Josh at 5%, the bank makes 3%. Okay. And so what they're talking about is that lower part of that rate, that, borrowing from the Fed at 2% or whatever that is. Okay. So that rate increased. What was really interesting is that we saw a couple things. Number one, we saw an increase in most major markets, stock markets, equity markets. Okay. They actually increased. We saw a big bump the other day because what happened was we saw that there was a sigh of relief from investors, like, oh my God, the Fed actually gets it. They're going to hammer on inflation, and we see brighter horizons in the near future. And so there was a rally in the stock market. When there's generally a rally in the stock market, what happens is people pull money out of bonds, and then they put it into stocks. So it's kind of interesting. Mortgages are bonds, essentially, okay? But they also rely on liquidity. And so I don't want to overcomplicate it, but it didn't have a direct impact on mortgage rates. Matter of fact, it had the inverse impact, okay? Because people are saying, there's some relief. I don't expect inflation to keep increasing, because if if inflation is at 10%, but I'm loaning you money at 6%, guess what? I'm taking a 4% hit of my money, okay? Banks don't like when they lose money. It's purchasing power, and so they don't want to do that. So when they see the Fed get ahead of the inflation's coming down, they can say, hey, cool, I'm confident lending money out at a cheaper rate because I know that inflation is not going to be super high in the near future, okay? Did that make any sense at all?
For your average user, maybe. I don't know.
That was pretty complicated.
You might need to do some layman's terms on that.
Okay.
Break it down.
Long story short, don't worry about the overnight Fed funds rate. Doesn't matter. Okay, what you're looking at is the 10-year yield on treasuries.
There we go.
Bam.
Where can somebody find the 10-year yield? For
just
treasury
literally,
funds?
you can go into Google or any kind of search engine and say 10-year treasury. Okay, and they can look at the rates.
Perfect.
And it's going to give you a benchmark of what the 30-year rate, 20-year rate, 10-year rate of mortgages are approximately doing. Mm-hmm. And so that's the biggest indicator of interest rates, not necessarily the federal funds rate, okay? Very important thing to understand. And so, in long story short, because the Fed got so aggressive with the interest rate increase, that they're tamping inflation, that people are more likely to lend longer term at a lower rate.
Yeah. So do we see an increase in mortgage rates, or do we see something more stable? We saw a decrease, right? 5.35 is what it was.
5.375 as of today. Don't quote that. It's just a generic term, because
Very
I cannot
generic,
quote
guys.
APRs. I cannot quote points. I cannot quote rate. You're looking in the low fives. Okay.
Yeah. That's
for 30-year fixed.
And that was from our beautiful source, Mike Burke over there at JFQ Lending.
Correct.
Thank you so much, Mike, for providing the information.
Definitely.
If you guys need a mortgage, make sure you reach out to us to put you in contact with Mike and JFQ. They will get you set up.
Definitely.
So don't believe what you see in the headlines.
Correct.
Make sure you have, just like we were talking about, make sure you talk to the professional.
Yep.
They're going to get you approved and show you exactly what your interest rate specifically was going to be, because it's very situational. Not everybody's getting that 5.35, right?
Correct.
Just within the ballpark
Generally.
That really, really is. Okay.
Yes.
Cool.
Perfect.
All right, guys. Well, thank you so much for tuning in to the Inside View Real Estate Podcast. That was your information on interest rates and the truth about mortgage rates. We'll see you on the next episode. What's up, guys? Thank you so much for tuning in to the Inside View Real Estate Podcast. Make sure you like, share, comment, and subscribe. We want to continue to bring you so much value every single episode. Until next time, see you on the inside.